back to the point wherein you said you're still positive on real estate. Given the fact that the stocks have run up quite a bit in the last couple of years, perhaps even ahead of fundamentals, and there are initial reports talking about how that sector might have just plateaued out a bit in terms of the inventory building up or the registration slowing down, at least in certain segments, wouldn't it be better to play through the building material side, because that is where the comfort of valuation lies?
A good spot. So I think when we talk about real estate, we talk about direct plays as well as indirect plays. And clearly the direct plays, which are the builders, have done quite well over the last few years. I would argue that they have a few, the runway is still ahead of them. They would do well as well. But going forward, maybe the ancillary sectors like the building materials, which haven't done as well, will actually continue to do, will actually kind of start to improve. I do see a bit of a further 6-9 months gap, after which that trend starts to pick up, because we think the initial stages of the project completion is not yet fully done. So in sync with what you are saying, but it might take a little more time. In the meantime, builders might continue to do well, particularly kind of, if the rate cuts happen, the relative attractiveness of real estate kind of tends to go up a little bit, and they would also stand to benefit from the same. So we, at the moment, from builders' perspective, we are a little more selective, holding on to the ones which are which have a strong launch pipeline, and gradually building our positions in building materials or ancillary sectors is the way we are approaching this sector.
All right, but